Welcome back to Mid-Cap Radar. Well, the next company on our radar is Inventress Knowledge Solutions. It reported a stable set of Q1 numbers. The company reported a stable revenue growth and margins improved on a year-on-year basis as well. We are now joined by Nithya Balasubramanian, who is the CFO at Inventress Knowledge Solutions. Thank you so much, Nithya, for joining us. Well, the first question is revenue growth for the company has essentially been in the range of 15 to 16% in the last 3 quarters. Will that sustain going forward, FY26? Can you quantify the guidance as far as the 3 main parameters are concerned? And what are the incremental growth drivers for you?
Thank you for having me. We're obviously pleased to report another strong quarter and strong set of results. I think we've always maintained that not just in the next quarter, not just the next year, but over the next 5 to 7 years, we would want to continue to grow faster than market. Our market is, the outsource market in the US is about $34-35 billion, which is expanding at about 12%. And we want to be able to consistently beat that market growth so that on an ongoing basis, we continue to gain market share. So along those lines, therefore, this quarter as well, we have reported a 16% growth in revenues. And of course, a much higher growth rate in terms of EBITDA. Our margins came in at 32%, which represents a 36% year-on-year growth. The margin expansion is also reflective of the business transformation that we've achieved in the equity asset that we had acquired a couple of years ago.
Nithya, you're talking about this growth to continue over a couple of years that would come by, and your top 5 customers, that's where the revenue has been increasing, the share has been increasing as well. Can you give us a sense of, is it particular to a certain geography that you're seeing that kind of growth? Is it particular segment? If you can throw light on what kind of percentage share will you get from top 5 customers down the line?
So the growth is actually being quite, it's actually across the board, right? So one, in terms of geography, our focus is entirely in the US market. So all the growth that you're seeing is actually coming from the US market. But within the market, if you look at different market segments, I think our growth has been fairly secular across the various segments as well as the different features of the platform that we offer. We have seen growth from new customers and new new deal wins. We've also seen growth from our platform customers continuing to scale up. And we've also seen our land and expand strategy with our existing older customers also play out. So it's a healthy mix across the board, and therefore we believe it's sustainable going forward as well.
Got that. Nithya, the other question is, as far as a couple of your top clients are concerned, quite a bit of transition going in over there. Number one is Palomar, there could be a change of control over there. The second one is United Health. Remember last time we had you on the show, we spoke about United Health and the troubles that they were facing. Now, given that churn, do you continue to stay confident of growth as far as these particular clientele is concerned?
No, absolutely. I think both of these are very important customers for us and growing customers for us. Palomar, if you will remember, was our first customer for our entire platform. So they've bought all 16 features of our platform from the get-go, and it's a very long-term, 15-year deal, in fact. So our relationship with them continues to grow, and we continue to get to 100% implementation of all 16 features of our platform. And in fact, more recently, I think what's been in the news is that they're in conversation with UC San Diego, which is obviously one of the largest health systems in the US, about a potential partnership. So we believe that that signals to us continued health of Palomar, the Palomar health system. And of course, we are cautiously optimistic about the opportunity that brings to us as well in the future.
Okay, you briefly mentioned, how the asset equity has been performing. Going forward, what is the kind of ambitions that you have over there? And Nithya, a quick word on how the entire emerging tariff situation, could impact the pharma market in the US. And do you see any spend impact as far as your own prospects are concerned?
So your first question was on equity and what we hope to see in the future, right?
Right.
So I think for the large part, there were 2 very important reasons why we bought equity. One is, of course, the margin transformation that we could achieve through a deployment of IKS's technology, as well as getting the right balance of the onshore-offshore mix. I'm very happy to report that a large part of that transformation has already played out, which is what is reflected in the very healthy margins that we've posted. The second big vector why we acquired Acuity was actually the cross-sell opportunity. Again, very happy to report that we have started seeing green shoots. In fact, last quarter as well, we had mentioned that there are 4 cross-sell wins that we have now been able to bank. And this quarter as well, we had reported expansion of a relationship with the top health system, which also is a cross-sell win for us. So going forward, you will start to see a ramp up of these deals that are now in the mix. And of course, we believe that there is more to come in the future. So that's with respect to Acuity. And to your question on tariffs, thankfully, I think the services, technology and services is outside the purview. We do not see any meaningful impact, therefore, based on the recent tariff conversations and the ongoing negotiations.
Take that point, Nithya. Thank you so much for joining us with your thoughts and outlook on company's plans and growth going forward. That's the word coming in from IKS. So with that, we'll do one thing. We will take your leave on this edition of Midcap Radar. Stay tuned. Your stocks when we return.